Let's jump right into this explainer and completely demystify the core principles of IFRS 15. For the longest time, businesses would essentially just look at the cash hitting their bank accounts and call it a day, but this standard radically shifts that focus. It moves us away from simply asking, hey, how much cash did you receive, to really analyzing what you actually should receive for the specific goods and services you've transferred to your customer. It's really all about capturing the true economic reality of the transaction. Now, because this standard is an absolute beast, we're going to break it down logically into 5 parts. We'll hit the 5-step revenue blueprint, decoding the transaction price, the principal versus agent dilemma, returns and warranty rules, and finally, special sales and storage. All right, Section 1, the 5-step revenue blueprint. Let's start by laying the absolute foundation of our accounting house. This is the 5-step model that governs literally every single revenue transaction. Think of it as your ultimate blueprint. Step 1 is to identify the contract with the customer. Step 2 is identifying your performance obligations, which basically just means asking, what exactly did you promise to deliver? Step 3 is figuring out the transaction price. Step 4 is taking that price and allocating it to those specific obligations you found back in Step 2. And finally, Step 5 is where you actually recognize the revenue when you satisfy those obligations. This flow guides you seamlessly from the very first handshake all the way to recording the numbers on your income statement. So what actually triggers that final step? How do you know an obligation is truly satisfied? Well, it all comes down to transferring control. Control simply means the customer now calls the shots. They have the ability to direct the use of the product, and they reap substantially all of the economic benefits from it. Once the risks and rewards are officially in the hands of the customer, and they have physical possession or legal title, control has transferred, and boom, you can recognize the revenue. Moving right along to Section 2, decoding the transaction price. What's really interesting here is how we handle Step 3 of our blueprint, because in the real world, transaction prices are rarely just a simple, flat fee. Often the amount of money you're going to get is pretty uncertain. Imagine you're a real estate builder. Your client tells you, look, if you finish this building in a year, I'm giving you a massive bonus. A year and a half, a smaller bonus. But if you're late, I'm hitting you with a penalty. That uncertainty, not knowing exactly what the final dollar amount will be, is what we call variable consideration. The big question is, can you include that uncertain bonus in your revenue today? You can, but only if it meets this absolute golden rule. You must be extremely confident, like highly probable, that a significant reversal in revenue will not occur once that uncertainty is finally resolved. Basically, IFRS 15 does not want you recognizing a massive bonus today, only to have to erase it from your books next year when you miss the deadline. To actually measure that variable consideration and put a hard number on it, the standard gives you 2 tools. You can use the expected value method, where you calculate a probability-weighted average of all the possible outcomes. Or you can use the most likely amount method, which simply picks the single most likely outcome. You just have to choose the method that best predicts the amount you'll ultimately be entitled to. Let's look at another modifier for the transaction price. What happens if there's a massive time delay between when you deliver the goods and when the customer actually pays you? If that time gap is more than 12 months, the standard says you have a significant financing component. When that year-long gap exists, you're essentially providing a loan to your customer, or maybe they're providing one to you. Either way, you have to adjust for the time value of money. You do this by recognizing the cash selling price, meaning what the item would cost if they just paid in cash today, as your actual revenue. Any extra money you receive on top of that cash price over time, that's not revenue from selling goods. That gets treated separately as interest or finance income. But hold on, what if the customer pays in goods instead of cash? This introduces a really fascinating scenario called non-cash consideration. What happens when you sell your products, but instead of handing over a check, your customer pays by giving you some of their own inventory or equipment? It completely flips our normal cash-based thinking upside down. You solve this by simply recognizing revenue at the fair value of the non-cash item you received in the trade. If a customer gives you a piece of machinery in exchange for your consulting services, your revenue is simply the fair value of that machinery. And if, for whatever reason, you can't figure out the fair value of what you received, your backup plan is to use the fair value of the services you gave up. All right, Section 3, the principal versus agent dilemma. Let's see who actually gets to claim the revenue when multiple parties are involved in a single sale. If a travel platform like Make My Trip sells a $600 Indigo flight, who claims that $600? Well, Indigo is the principal here. They bear the primary responsibility for the flight, they set the price, and they take the inventory risk if those seats go empty. Because of that, Indigo recognizes the gross $600 revenue. Make My Trip is just the agent facilitating the sale, so they only recognize their net commission. Let's say it's $100 as revenue, definitely not the full ticket price.
Now for Section 4, Returns and Warranty Rules. A super crucial point is how to handle a sale when the customer might reverse it or demand future fixes. If you sell items with a right of return, think of your standard Amazon purchase. You cannot recognize revenue for everything you ship out. You only recognize revenue for the units you statistically expect the customer to keep. For the goods you expect them to send back, no revenue is recorded. Instead, you set up a refund liability for the cash you'll have to return, and you recognize a return asset for the inventory you expect to get back in your warehouse.
Warranties can be equally tricky, but IFRS 15 makes a really clear distinction here. An inbuilt standard warranty, like the one you get automatically with a new TV to guarantee it turns on, is not a separate performance obligation. It's just treated as a standard liability provision for future repair costs under IAS 37. But if you sell an extended additional warranty for an extra fee, that is a completely separate performance obligation. For the extended warranty, you spread that revenue out and recognize it over the time period of the warranty itself.
And finally, Section 5, Special Sales and Storage. Let's tackle a few quirky, unique business models that test the absolute limits of that 5-step blueprint we talked about earlier. Imagine you're buying a ton of clothes at a department store, like Shop or Stop. You've paid for them. But you ask the cashier to hold your bags securely behind the counter while you go grab lunch at the food court. In the corporate world, this is what we call a bill and hold arrangement. The customer has bought the goods, but the seller is physically storing them. Now, usually, physical possession is a massive indicator of control. So to legally recognize revenue before the customer actually takes those bags home, 4 incredibly strict criteria have to be met perfectly. 1, the customer must have requested the hold. 2, the product must be separately identified as theirs. 3, it has to be completely ready for physical transfer. And 4, the selling entity absolutely cannot use the product or redirect it to someone else. If all 4 are met, you can actually recognize the revenue while still holding the inventory in your warehouse. Also, keep in mind, the standard really cares about economic reality, not just the legal paperwork. If you sell an asset to a customer, but you have a commitment to buy it back from them later at a higher price, IFRS 15 steps in and says, hold on, that's not revenue at all. Economically, that is just a disguised loan. You're basically borrowing money using the asset as collateral, so it has to be treated as a financing arrangement. So, now that you hold the blueprint to IFRS 15, you really have the tools to see past the surface level of any contract. Whether you're dealing with variable pricing, time value delays, or complex agency structures, you know how to hunt down that core performance obligation. The big question is, are you ready to look closely at your own contracts and discover what your revenue really is? Thanks for joining me on this explainer, and keep exploring the reality behind the numbers.